I am going to bring on Nick. Hey, Nick.
Hey, Mike, how you doing?
Good. So you win the award for the best screen setup so far. My goodness.
All right, sweet. This is happy to hear it.
Mm. I love it. So Nick is someone that I've known now, once again through networking and through the joys of LinkedIn and the amazing part of the internet. I've known Nick for a couple years and it's been incredible. He's been a fantastic resource. I love talking to him about the accounting side. I think in healthcare, there's so much misinformation, Nick, about 1099. And you and I have talked in the past, this obsession with S Corp being this magical
Mm,
thing where you don't have to pay taxes if you're an S Corp, right?
it's the best.
So, so I'm so excited. I love when we get to nerd out. I hope this is helpful for our audience. But without further ado, Nick, I'm going to give it to you. I'll let you do your own bio, do your own intro, and then take it away. And hopefully, we've been having some occasional screen share issues with privacy settings. So
Okay.
hopefully, we don't have any tech issues there, but the floor is yours, Nick.
All right, sounds good. I'm gonna try and go ahead and share my screen, my presentation. Let's see if that does in fact work for me. Um, so I can have this up in general.
Looks good. Great success.
All right, perfect. So, my name is Nick Krop. Going to be going over kind of an accounting overview for 1099s, how to thrive as a self-employed clinician. But the main idea is this: how you, as a 1099 person, you're a self-employed person, you're a business owner, right? And what we can do with that, just kind of go over some of the basics, like some of the best practices we can have as a business owner, just some general things about deductions, some of the most asked about things, which would be like home office and vehicle deductions, which I think will be a large part of this, but I think is the most questioned, and what can I do with those? So I think it's an important topic. A little bit on retirement, a little bit on deadlines, but just overall, talk about everyone's favorite topic, which is accounting. Little about me. My name is Nick Krop. I am a CPA. I'm a partner of Cornerstone Accounting Solutions, and we're located in Sykesville and Frederick, Maryland. Those two locations don't mean anything to you if you don't live in Maryland, but now you know them. My expertise is tax preparation and business, uh, and what I mean by that is not just individual tax preparation, but also tax preparation for businesses. And the reason why I'm differentiating that I'm an accountant that deals with tax preparation is because obviously accountants can be in many fields. You can have people who just work on the financials, the back end, cost accounting, auditing, compilation. Don't do those things really. I mean, we do some bookkeeping and things like that, but generally speaking, my expertise would be tax preparation and financials business. My experience, I've been a tax preparer. I've been preparing taxes since 2020. I've been doing back end financial management for businesses since about 2015, 2014. I'm also a licensed real estate agent, real estate broker. Since about 2015 or so, I've been dealing in real estate. So if I were to really niche down into an area of accounting and tax preparation, it would probably be somewhere in real estate, right? I deal with it personally, but also I have a lot of clients in that field that I do tax work with and things like that. So it's definitely an area I have a lot of expertise. But that said, we have a lot of businesses. Actually, me and my family, I have a couple businesses with my brother and my father. He's also one of the partners here at Cornerstone, in addition to another partner that we have. We do a lot of other business, just kind of like generally, in addition to real estate investment. Like my wife's social media manager, and she does like photography and videography, and we've done some of the things like we have a gun range out here, and we have had a gluten-free restaurant, and we've had some publishing for do a lot of things. Enjoy business. Business in general is a fun topic for me. It's something where I feel I can provide a lot of value for my clientele. So like business. Um, my approach is I like to educate my clients on tax strategies, right? To obviously minimize tax liability, but also ensure compliance, right? I don't want to just do something just because something exists in the tax code doesn't mean it's applicable to everyone. So we want to make sure we're in compliance in the things that we're doing. Um, but I want to make sure that I'm educating you on the thing that we are doing, that I'm not just telling you black and white, this is what you can do, this is what you can't do. Let's come along together on the journey of figuring out what it is that we can and can't do, making sure that you know what it is I'm talking about, right? And the modes of education that I typically have is I do utilize social media. I've met a lot of people online. I unfortunately don't use LinkedIn too much. I do connect with people a little bit on there, but mostly I utilize TikTok, Instagram, and YouTube, where I put out a lot of educational content on taxes. Again, I know everyone's favorite topic, so I'm sure everyone's going to just be jumping out to go find me on there. Also, one-on-one meetings with clients. So people that we do tax preparation for are our clients, and I have consultations, tax planning, things like that, where I meet with them. And obviously, that's the best place where I can get good, non-generic, non-general information to them about their specific business, how these tax strategies may apply to them. So that is also where I like to be able to educate clients. Another thing I'm also rolling out for my office, the cornerstone of Sphere, if you will, is just webinars throughout the year. Just being able to get to them the general information that they need. How do I take advantage of certain strategies? How do I buy real estate? What does that mean tax wise? How do I pay my kids for my business? What type of entity structure should I have? Partnership, S corp, whatever it might be. Just some general webinars throughout the year to be able to have some Q&A with clients, give them some general information, make sure that they don't get to the end of the year and say, my accountant never told me about whatever. I want to make sure that it's at least presented to them. If they choose not to participate, that's totally fine. But at least I'm getting as much information as I can out to all of my clients to provide as much value as I can. And my goal is obviously making tax strategies accessible and practical for individuals and business owners. Again, I work with both. Business owners, I definitely can provide a lot more value for just because there's more moving parts within a business. So enough about me. Let's get into it. So, first thing I want to talk about is just some of the general best practices to have as a business owner, whether you're a physician or a clinician or whatever you may be. The best practices as a business owner. This is step one. If I'm 1099, whether I'm operating under my own social security number, I'm operating under an LLC, whether I've elected to be treated as an S corp or C corp, none of those things matter. You are a business owner, regardless of the entity type that you have, and regardless how you choose to operate the business. You're a business owner. So here are some good best practices to have, regardless of the entity type. Keep track of your income and expenses throughout the year, right? You should know what you're actually making. There's a lot of confusion that people have when they talk about what they make as a business owner. They say, well, I made $500,000 and then I had a bunch of write-offs. And after that, I only pay taxes on $200,000. It's really not the way you should be looking at your income. As a business owner, you should be saying, I generated $500,000 of income in my business, revenue in my business, and I had $300,000 in expenses. I made $200,000, right? Your profit is what you made because that's what you're going to pay tax on. That's the money that you actually were able to keep from that business, right? Your expenses are required to generate the revenue. So look at it as that bottom line, that profit number. That's what you made. And if you're keeping track of things throughout the year, you'll actually be able to see what it is you're making. You're not just saying like, well, I have all this money, but where did it all go? You'll have a good idea of where it all went if you're keeping track of things throughout the month. So keep track of those things on a regular basis. Know what your profit is. The first step in being able to do this more easily is get a separate bank account and credit card for your business, right? Try and not commingle things. Now, here's the thing. If you're a sole proprietor operating under your social security number, right, you're going to get a 1099 under your name. I get a 1099 to Nick Krop, my social. I'm a sole prop. I'm going to file on Schedule C on my personal tax return. I can technically commingle my funds in my personal account. That's okay. You're allowed because you and your business are really not separate in any way. But it just makes it harder. If you're ever to be audited, I really have to comb through and tell them this was personal, this was business, and I have to prove a lot more. If I have a separate bank account, even just a separate bank account in my name that I'm operating my business under, right? It makes it a lot easier to track. Okay, these are all my business deposits. These are all my business expenses. Just a great first step in operating correctly. You setting up an LLC can definitely help with the separation, especially someone where liability, reducing your personal liability for things that happen in the business. It would be wise to have an LLC in your position. Does it change anything tax wise? Not inherently. I set up an LLC. I'm still operating like a sole proprietor in terms of my tax returns, filing in Schedule C. I can make elections to be treated as an S corp or C corp or whatever, and we'll talk about that a little bit later on. But the idea of an LLC at least creates separation between you and the business entity. If someone sues the business or suing this and not you and your personal assets, but setting up the LLC also allows me to set up a bank account to put things in. And I do understand. Quick little side note: when you set up an LLC initially, you're probably not going to be approved for a credit card in the name of that LLC. That's totally fine. Use a credit card. If you want a credit card for your business, use a credit card in your name, just used exclusively for your business. There you go. Now you got your business bank account and credit card. First step, that's what is going to make your life a little bit easier, keeping track of those income and expenses. Second thing is keep the receipts that you have throughout the year. But do know this, it's not like you cannot deduct something just because you don't have a receipt for it. Number one, bank statements and credit card statements can act as receipts for you. Um, the IRS says that your bank statements, your credit card statements are actually considered a form of receipt. But obviously, if you were to be audited and they need more details, the actual receipt with the details of that purchase are going to be what they look for. So keep as many as you can. But again, it's not the end of the world if you don't have every receipt of everything you purchased. Good practice though to you go somewhere, you buy something in store, take a picture of it, throw it in a cloud drive somewhere. If you otherwise have your bank cards, credit card statements, things like that, those will be okay for you as well. And then the last thing is find a system to categorize your monthly income and expenses throughout each month, right? We're keeping track of things. We're keeping things separate. We got them in a separate bank account and credit card. That's the first step, right? We don't want to wait till the end of the year to see what we're making, obviously. We're keeping our receipts and everything like that so we know the details of the things that we purchased. But then on a monthly basis, I would say at least go through. You can utilize apps like QuickBooks Zero, Wave Accounting, whatever it might be, but you don't have to, right? It's not a mandate. You can use an Excel sheet or a Google spreadsheet, especially if this is maybe a small piece of your current income. Maybe you have a lot of W-2 and you're just doing some things on the side, some like consulting work type of things on the side for 1099. It's fine. Keep a spreadsheet of things. Keep a separate bank account. And you have a spreadsheet. You're just saying, okay, here's the income I made. Here's the amount I paid on supplies and software and things like that for the business this month. And I can see my profit that I'm making on a monthly basis. Those are the best steps to getting started, especially with your business, is keep things separate, make sure you're keeping good receipts, records of the things that you're purchasing, and then just find a way to kind of keep track of things, put together some kind of profit and loss statement as you go, right? Then as you grow, it's going to make it a lot easier for you to be able to expand and pivot and make moves because you have good financials throughout the year. So that is just my general recommendation right off the bat when I start a business. If I'm getting 1099s, I'm a business owner. What do I need to be doing? Treat it like a business, right? Again, all of this also helps protect you in case of an audit to show that this is obviously not a hobby, that this is a clear business activity, and that I'm operating this in a workman's like in a business like manner. So the next question I always get asked about, especially when people first start their business, is, okay, what do I pay taxes on? Or, how do I pay myself for my business? And again, we're mostly going to be talking about single member LLCs or sole proprietor, right? You're going to file on Schedule C on your personal tax return. And the most important thing to understand is you will pay taxes on the profit, not on what you pay yourself. So how you pay yourself is however you want. Money comes in the business, pay for things for the business. You need money personally, draw it out of the business, put it in your personal account. It will not affect the amount of taxes you pay because you're going to pay taxes on the net income of the business. And to give you a quick example of what I mean, if you have $200,000 business income, you have your expenses in there, right? You got some advertising, some office expenses, some rent expense, whatever it might be, right? Say you got $58,000 worth of expenses and your profit at the end of the year is $142,000. You are going to pay taxes on the revenue minus the expenses to equal your net profit. That number right there, that is what you're going to pay taxes on. If you started your business January 1, $0 in your bank account, you made $200,000, you spent $58,000, say at the end of the year, $142,000 remains in that bank account, right? You didn't take any out. You're going to pay taxes on $142,000 of profit. Same scenario, make the same amount of money, but you drew out $100,000, put it in your personal bank account. You're still going to pay taxes on $142,000 because it doesn't matter what you draw out. All that matters is what the net profit is of the business. And again, if you are operating as like a single member LLC or a sole proprietor, you're not putting yourself on W-2. You can write yourself a check. You can Venmo the money. You can Zelle the money. If your bank accounts are connected, transfer the money. Whatever you're needing to do, when you take the money out of the business account, put it in your personal account, it's just distribution. It's not going to affect your income. It's not going to affect what you owe in taxes, right? And this is why it's important to keep track of your income and expenses throughout the year to see what your profit is, to see what you actually made, because that's on which you're going to pay taxes. And that helps you plan for things during the year. So just a common question. How do I pay myself? However is most convenient for you. So then there's the other question I get all the time is, okay, what can I deduct as a business owner? The easiest thing to think about, and I know a lot of people will throw around whatever's ordinary necessary. That even itself is kind of confusing. Think about the things that are directly related to the business itself. There are going to be some gray area things that are going to be on the margins, but there are going to be some things that are just obvious. There's going to be things such as rent, if you're paying for rent for your meeting with clients and things like that, the utilities for that office, office supplies and equipment, maybe home office. We'll get to that in a second. Yeah, and then you're going to have insurance that's for the business. You're going to have continuing education, your membership dues, marketing and advertising is obviously related to the business cards. Then you're going to also have technology and software. The software is definitely going to be a huge thing you're going to have to pay for. Again, there are going to be some things maybe on the margin, like, okay, is my Word and Excel deductible, even though like kind of use that cross my various, uh, work life balance right there. Or, is my Zoom meeting going to be deductible? For the most part, if it's being utilized the majority for your business, I mean, yes, it's de minimis in terms of its personal slash business use. In fact, probably there is no personal use for it. And so those are things that are directly related to your business. And then you're going to have things like bank fees, accounting fees, your contractors or your virtual admins. These are things that are deductible. Again, you're gonna have some things on the margins here, such as mileage, car expenses, travel expenses, home office expenses. That depends on what we're doing with those things. But again, those things are directly related to the business. It's ordinary for you to have to pay for continuing education, and it's necessary for you to either go somewhere to do it or to do it online. What you pay for it doesn't really matter. There's no luxury amount that's like, oh, well, you can't travel to Hawaii for a conference. That's not ordinary necessary. Sure, it is. It's ordinary necessary for me as a licensed professional to get continuing education, and sometimes you have to travel for it. That's pretty ordinary. It's completely necessary for me to have to travel over there to get that. Just because I'm enjoying my time in another place, getting my education doesn't make it not ordinary necessary, right? So again, that's where that phraseology can be a little bit confusing. So I'll just really focus on what is directly related to the business. But remember, each business is different. So some things that may be applicable to you may not be applicable to someone else. And so again, as you kind of dig into, okay, what are things I'm able to expense in my business, that's where having an accountant to be able to ask these questions to is a really good thing to have in your business, right? Someone that you can ask specifically about your business, they know your business, and they can answer you specifically on what you would be able to deduct, right? So there's definitely going to be some of those things, but the majority of the time is you're going to know what is deductible for your business. But then we're going to get into kind of the meat of this, right? So this is something people always have questions about, right? Can I get a home office deduction? And this will lead into the next biggest thing they ask about is how do I write off my car, right? Let's talk about the home office first because this is crucial to getting a larger amount of vehicle deductions, which we'll get to. But I want to explain how you can actually take a home office deduction, right? So the main premise is that you have a space in your home that you use regularly and exclusively for business. It can be a part of a larger room, but it's nice if it is a room in and of itself, just a little bit more defensible. You don't need to own the home. You can rent the home and take the home office deduction as long as you are paying for the rent. If you're living with someone else and you're not paying for anything, there's nothing to deduct. There's no need to meet clients in the home. It does not have to be a place that you meet people for it to be considered your home office. There are two ways you can take it. You can take the simplified method, $5 per square foot, up to 300 square foot of a home office space, so up to a $1,500 deduction, or the regular method, which is a proportional share of your home office's space of your home, your business use percentage. And then bonus tip here, we're not going to really dig into this too much, but there is something where you can use what's called a net square footage, which is instead of looking at, let's say my office here is 300 square feet. And let's say my home is 3,000 square feet, right? So that means I'd have 10% business use of my home, 300 over 3,000. But let's say I say, I'm not going to use the taxable square foot. I'm not going to use what the tax record says is the square footage. I'm actually going to measure each room I have in the house, right? Because I have walls and I have hallways. Those are non-usable space, right? So I'm going to measure all the rooms in my house. I'm going to say, okay, it's 300 square feet out of 2,200 usable net square footage of my home. I'm allowed to do that. It is a defensible thing that I'm able to do. And that can, without doing anything more, increase the amount of deduction I get for my home office space. So just a bonus tip there. Definitely something to talk about with your accountant. It takes a little bit of extra work, but once you have it measured, just write it down. Make sure you take pictures of these things that you're doing. That's your defense for things if you ever get audited. But understand there are ways to increase the home office deduction is a sunk cost. I have to pay to live somewhere. And I'm already paying for my utilities, my rent, my mortgage insurance, all of those things. They're already going to be paid for. And if I'm using a space in my home for business, I can get a deduction for it. So understanding how we can utilize this is pretty important. But all of that said, I know a lot of us are thinking, well, I have a space in my home that I do work sometimes from, right? No one else uses it. The kids don't go in there, and no one, my wife or my spouse doesn't go in there or anything like that. This is definitely exclusively used for business. That's great if it's exclusively used for business. But then we really have to look at, okay, what are the rules behind being able to take a home office deduction? It goes a little bit beyond just regular use. It's also that exclusive, I mean, more than just that exclusive use, it's that regular use, right? So I'm just going to go over a few of the rules from the IRS just so this can kind of be nailed down. So you know what you need to do, what your activity needs to be to fit within the parameters of the IRS tax code. It's not enough to just know about the home office. You need to know, okay, what are the parameters the IRS has set out for me? And then how do I fit my activity inside of this? If I can fit my activity inside of this, I have a defensible deduction for me, right? So first thing is you can deduct business expenses applied to part of your home only if that part is used exclusively on a regular basis. And here's the three potential uses, essentially, as a principal place of business for you or your trades or businesses, because that's number one, or as a place of business used for your patients, clients, customers to meet or deal with you in a normal course of trade or business. Or do you understand that number two there, that is an or. You don't have to meet people in your home for it to be considered a home office. But if you do, that can also be a means test for making it your home office. Or three, it's in connection with trade or business, and it's a separate structure. So if I have like a separate little structure on my yard that I use exclusively for business, that would also be considered home office space, right? So we're going to look at number one. This is what most people are going to be dealing with. They have their office space. Okay, so I have this space in my home that I use exclusively for business. Now, what does it mean for it to be a principal place of business, right? In order for it to be a principal place of business, in order for your home to qualify as your principal place of business, you must consider the following two items: the relative importance of the activities performed at each place where you conduct business, and the amount of time spent in each place where you conduct business. And your home office will qualify as a principal place of business if you meet the following requirements. You use it exclusively and regularly for administrative or management activities of your trade or business, and you have no other or you have no other fixed location. I'm sorry. And you have no other fixed location where you conduct substantial administrative or management activities of your trade or business. And we'll get into what they mean by that. But understand, so the importance of the activities you're performing here, as well as the time spent here to conduct those regular administrative activities of your business. So as you can see, they didn't say you need to spend 4 hours and 1 minute. They didn't say you need to spend 2 hours here and only 30 minutes over there. Time is never mentioned by the IRS. They never get specific because things are broad. But what they're saying is you're not doing unimportant work here. What that means is you're doing regular work consistently. So every day, let's say 4 out of 5 days at least, you're doing work in your home office, and it's consistent that this is where you perform those activities. And so now we're going to hone in on, okay, so what are those administrative or management activities that I need to be doing on a regular basis? No time necessarily involved, but on a regular basis. And it's a substantial part of the activities for my business that will help me qualify as a principal place of business. So administrative or management activities, I'm not going to read all of these, but it's like billing customers, keeping books and records, so doing your own books, ordering supplies, maybe having virtual meetings with people and things like that, right? So this is where you start the day off. You're doing a lot of things here. You're calling people, you're working on your marketing. This is where you come back at the end of the day, and that's where you're going to finish out billing people, making sure that everything is in compliance with whatever you need to report. All of those things are happening really from your office here, right? This is your office. This is where you're doing the things that you need to do administratively for your business. And those administrative management activities performed at other locations don't necessarily take away from this. Obviously, if people are, if you have a second office, right? So you have your home office, and that's where you do the majority of your stuff, before you go into your main office or your second office. You can have other employees doing other things over there. That's totally fine. That doesn't take away from your management and administrative activities, right? Because you're a part of the business. They're a part of the business. It doesn't take away from it. And you can conduct your administrative activities in both places as long as this is where you do the majority of it, or the substantial amount of it. That's the most important thing. But you going to a car or a hotel room doesn't take away from your home office as well, because those are kind of temporary locations. And your occasional conduct in those things at the other fixed locations doesn't take away from this, right? So if I have a second office and I have an office there where I can sit down and maybe in between clients or something like that, in between meetings or in between working with my employees there, I answer a couple of emails and I do a couple administrative things. But again, the majority of where I plan to get those things done is back here at my home office. As long as that is the intent and that's where I'm really getting things done, then that second location doesn't take away from your home office being your primary place of business. Um, that's kind of what you're looking at, right? And then it even says here, if you have a suitable space for you to conduct those administrative or management activities outside your home, but you choose to use your home office for those activities instead, still is enough of a defense for you to say that is my primary place of business, right? So, all right, let's see. Let's recap real quick. I have an exclusive use space for my business. I use it regularly. I do administrative or management activities in that on a regular basis, regardless of any second or third or whatever other office I have. This is where I'm getting the majority of those things done on a regular basis. All right. So now I have a home office, right? I've now proven it. I got my home office. What are my options available to me? Like I said, you got the simplified method, which is just $5 per square foot up to 300 square feet. So it's up to a $1,500 deduction. Or there's the regular method, which is the percentage use of your home, right? And again, what you would do is you would take the square footage of your home office divided by the total square footage of your home. And that is where you'll see your business use percentage. Again, 300 square feet divided by 3,000 square feet of my home in total, I'd have 10% business use. And I would take 10% of my mortgage interest or rent if I rent the home, my home or renter's insurance, my real estate taxes, my cleaning service, my repairs and maintenance inside the home, my utilities, my HOA or condo fees, my security fees. There could be some other deductions, some other expenses in there as well attributable to your home. Things that are dicey at best would be things like your landscaping and other external activities that you have going on at your home. If you're not meeting people physically here, if people never come to your home to do any type of business here, right? Again, it's not a predicate for having a home office as a principal place of business is to meet people. But especially if you're never doing that, the activities on the outside, I would say avoid that, right? It doesn't really apply to you because the way your home looks on the outside isn't drawing anyone in. You don't need to keep it looking nice for anyone because they're never driving up to your house, right? So at least those things inside the home, though, are directly attributable just to having the home, like the HOA or condo fees. Absolutely. Take 10% of those deductions. And now you might be saying to yourself, like, okay, that's great. Not a huge deduction. And it's really not. It's not massive. Its implications, though, are massive in vehicle deductions that I can take. But it's a great extra deduction. Say it's $3,000 to $5,000. Again, it could be nominal at best based on the amount of revenue that you're generating. But you're already paying for your home's cost. Just like I mentioned before, it's a sunk cost for you. You might as well get a deduction for something that you're already paying for that your business is utilizing, right? And it doesn't create commercial space in your home either. So if I take actual expenses and let's say I own the home, I will take a small depreciation deduction as well on my home's value on that, that 10% use of my home. It's very small. It's not huge. It is something. And all that does is when I sell my home, yeah, I'll have to recapture that depreciation. Let's say over 15 years, I take $10,000 of depreciation on the home. Okay, fine. I'll be able to exclude the gain on my home from having lived in it and owned it, up to $500,000 married, filing joint, or $250,000 single. I'll be able to exclude the general gain. I'll have $10,000 recapture of taxable income. Okay, it's small pittance for having been able to get that deduction. I'm getting all these other deductions. And to be honest, depreciation recapture on the sale of residential real estate or real estate in general is capped at 25%. So if I'm in the 37% tax bracket as I'm earning money, and especially when I sell the home and things like that, well, it's capped at 25%. So I'm actually still making out way better by having taken the depreciation along the way. So you understand there's really the negatives for it really aren't there. If you got the deduction, you have to recapture it at the same tax rate. Who really cares? It's kicking the can down the road for sure, but I'm able to take all these other deductions. It's definitely great. But as a single member LLC and self-employed, a sole proprietor, and things like that, it saves you on SE income. Definitely saves you on income tax, state income tax, additional Medicare tax. So it is a good deduction. It does save you money for sure. It's just not a massive deduction for you, but it has massive implications on the next thing that a lot of people want to be able to take advantage of, right? In order to maximize your vehicle deductions, having a home office really helps out by getting rid of your commute. And what I mean by that is this. When I drive from my home to my office, those are commuting miles. They're not business miles, right? I'm not able to do anything with that for business. Until I get to the first business location of the day, my business miles don't start. And why does that matter? Because in order to deduct anything for any vehicle in my business, I must have driven that vehicle for business. I must have business miles for that vehicle. So the higher my business miles are, the more deduction I get for my vehicle. Well, if my first trip of the day is going from my home to the office and I don't have a home office established, right? That means these are all commuting miles. They're the same as personal miles. They're not adding to my business mileage on my vehicle. Until I drive from this first business location to my second business location, wherever that may be, second, third, fourth, whatever, I don't have any business miles started for that day. And if all I ever do is drive from my home to the office and maybe an occasional thing over here, but then back home, I have really no business miles. So my car barely deductible. I barely have anything to deduct in that. But if I establish that home office, my commute is from my bedroom to my home office. Boom. First location of the day being my home for business. That means when I drive from my first office, my home, to my second office, whatever that location may be, those are business miles, right? By doing nothing else other than having the home office, not a huge reduction, but I just transformed a 20-mile drive from being all personal to now 20 miles of business miles. And this is extremely helpful in increasing the amount of deduction I get for my car because I have two options in being able to deduct vehicle expenses for my vehicle, and that's either going to be the actual method, a proportional share of the business use of your vehicle, right? So the proportional share of your expenses on your vehicle, or the standard mileage rate, which is 67 cents per business mile for 2024, 70 cents for 2025, right? So again, if I have that home office, my vehicle deductions start when I leave the house rather than once I hit that second business location, which may never happen in the day if we really only travel between our office at home and our office in that second location. So let me give you a couple examples of really what this looks like, right? And what I mean by the business use of your vehicle. Most important thing to understand when it comes to deducting a vehicle in your business is you have to drive it. Doesn't matter if you take phone calls in the car for business. Doesn't matter if you record a bunch of content about the car for your business, if you're on social media and things like that. None of those things add to the business use of your vehicle. The only thing that matters is how you drove it. And you need to drive it business miles. That means you're going from business location A to business location B. So for example, let's say you drive your car in total for the year 10,000 miles. And if 7,000 of those are for business, that means I have 70% business use. Again, that's why if we are able to up the amount of business miles I have, the more business use I have in that vehicle, the more I can deduct for that vehicle. So if I can start from home, it means my miles from home to the office and office to home, business miles. I'm going to have a lot more business use of my vehicle. I'm going to have a lot more of a deduction. And so if I'm taking the actual expenses of my vehicle, I would be able to take 70% of my insurance, gas, repairs, interest, or if I have a lease payment, my lease payments, my maintenance expenses, my car washes, everything like that, right? I take 70% of those costs based on my business use of the vehicle, which is determined by the miles I drive it. And then I'm also going to get a depreciation deduction if I own the car, right? If I lease the car, I get a lease expense. If I own the car, though, I also get a depreciation deduction. And this is kind of a confusing topic for many people. It's like, what is depreciation? Essentially, it's recovering the cost of the purchase price of that vehicle over time, right? So to give you a quick example, vehicles have a 5-year asset life for tax purposes. It doesn't really matter how long the car lasts. You depreciate it over 5 years. You expense it over a 5-year period, right? You recover that cost over that period of time. As an example, let's say the car that you used 70% for business was $50,000. That would mean you have a $35,000 business basis in that vehicle, right? And I would divide that over 5 years. It essentially gives me a $7,000 depreciation expense every year. Yes, when it comes to taxes, we use something called the declining method. So it does kind of change the amount of expense. It does change year over year. It's going to be more in the really second and third year as it is in the first, fourth, and fifth year. Doesn't really matter. I'm just using easy round numbers just for ease of kind of looking at this, right? So that $7,000 depreciation expense goes in addition to all those other ordinary expenses you have, the repairs and maintenance, insurance, and all of that kind of stuff. And where this is extremely helpful, especially if I have purchased the car with a loan, right? So I own the car, I just have a loan on the car. That means I'm paying a lot of principal payments towards that loan. That principal portion of the payment is not deductible for me. And this depreciation expense kind of helps me level out the cash outflow I have for the vehicle with expenses, right? I'm able to recover some of the costs of the purchase price of the vehicle, which is basically what I'm paying for on the loan. And so I have an equating expense to the cash outflow for my principal payments. And that is where the depreciation expense is helpful. Another way it can be very helpful, and what you probably have heard about a lot, is Section 179 and bonus depreciation on the G wagon that they just bought, right? So this is true that if you go out and buy a heavy SUV or you go out and buy a heavy truck, that there are these accelerated depreciation methods such as Section 179 and bonus depreciation, where you can take a larger first year deduction via depreciation. As an example, if I buy a vehicle that's over 6,000 pounds, I can at least take a 60% bonus depreciation deduction in 2024, and it's 40% bonus depreciation deduction in 2025. I can do that. I can take so if we have that $50,000 vehicle, and let's say we used it 100% of the time for business, I can take 60% of that. I can take a $30,000 deduction for that vehicle in the first year. I get a $30,000 depreciation deduction. And then I have $20,000 basis left over. I'll depreciate that over 5 years. Pretty sweet. Um, or if I buy a 6,000 pound SUV, I could take Section 179 up to $30,500 for 2024. Then I could take the 60% bonus depreciation on the remaining basis after that. So in the example where I had the $35,000 basis, I'd actually be able to take the full $30,500 of Section 179. I'd have $4,500 worth of depreciation left over. I could take 60% of that with bonus depreciation, and then the rest will be depreciated over 5 years. So I'm able to absorb most of the depreciation in the first year. And then certain trucks to go even further. Certain trucks and vans like cargo vans, like that have no seating in the back or have 9 or more seating in the back, or trucks with a 6-foot bed or longer that are over 6,000 pounds. I can actually expense 100% of the business basis of that vehicle in the first year with Section 179. So if I buy a Ford F-150 with a 6-foot bed, and I have $35,000 business use, I fully expense the $35,000 in that first year via Section 179. It's pretty great. Do know there are obviously caveats with this. You need to have over 50% business use in your vehicle in order to be eligible for bonus depreciation or Section 179. But still know you're still limited to the business use percentage, right? So even though I use it over 50% of the time in my business, doesn't mean I can write off 100% of its value. I can't write off $50,000 just because I use it more than 50% of the time. I use it 70% of the time. So I still only have the business basis of $35,000. I can take 100% of 70%. I can use 100% of my business use of that vehicle. So, and not only that, if your vehicle usage drops below 51% in future years, I'm going to recapture as income the excess depreciation I took in the first year. So do understand there are some caveats. I know that kind of gets into the weeds, but before doing any of these things, understand that. And know too, if you do have a loan on a vehicle, right, and you take accelerated depreciation in the first year, what you're going to have happen is you're going to get a deduction in excess of the money that you spent for that car, right? If I put $5,000 down, but I get a $35,000 deduction in the first year, I have a $30,000 deduction in excess of the money that I spent. That's pretty great in year one. But going forward, I'm going to be paying towards the principal of this loan. And I'm going to have no equating depreciation expense to offset that cash outflow. So yes, I had an advantage in year one, but in years 2, 3, 4, however long that loan is, I'm now looking at having more cash leaving my business account than expenses I'm going to have to reduce my income. So do know there's always pluses and minuses in everything that we do. So plan accordingly whenever you're taking these accelerated depreciation methods. They're great. They're fantastic. Make sure you've talked about with your accountant, you're planning on these things, and make sure too that before you go out and buy that vehicle, right, to be able to take advantage of Section 179 or bonus depreciation, that you have ensured that you have the business use percentage in a vehicle to be able to utilize any of these things. Just because I buy a vehicle that's eligible for full expensing with Section 179, or just because I buy a vehicle that's eligible for bonus depreciation, doesn't mean I'm going to be able to take it, because I still have to use my car for business and I still have to drive it those business miles. Then beyond that, the easier thing to do, obviously, and at minimum, I'm going to ask about this, right? So if you don't have a home office and you're not really getting too many business miles, but you do the occasional thing from the office to go visit some client or a vendor or something like that, you're going to have some business miles throughout the year. At least tab those things up. We're going to at least look at the standard mileage rate. You can take 67 cents per business mile for 2024, 70 cents in 2025. But you can also still take your proportional share of your car interest loan if you have a loan on it, and your parking and tolls. And uh, those are actually fully deductible. It doesn't really matter the use of your car that you have. If you have to pay for parking or tolls for a business meeting or something like that, that's fully deductible. It doesn't really matter about your business use of your car. It's unrelated to vehicle expenses. Your personal property tax on your car, if your state has that, you can take your proportional share of that as well. So those are cool things. Do know this as well. Another little caveat when it comes to vehicle deductions. This is either or. I can take the standard deduction or the mileage deduction. I can obviously not take both. And I also cannot really switch between them year after year. If I take actual expenses, I take the proportional share of expenses on my vehicle during the year. I take that depreciation, things like that, right? I'm stuck taking actual expenses. I cannot switch it back over to the mileage deduction. If I take the mileage deduction, I have the option to switch it to actual expenses in a future year, but I'm never switching back, right? So when you start taking expenses for a vehicle in your business, that first year is crucial to determining which one you should take, the mileage deduction or actual expenses. If you have a very inexpensive car that you're using for business, but you drive a lot of miles for business, you might find the mileage deduction to be way better than actual expenses. If I'm going to drive it 20,000 miles for business, but the car itself is a Honda Civic that cost me like $10,000 or something, well, I'm not going to really have much of a deduction for it. It doesn't really have much maintenance. It doesn't really have much in terms of gas. All of those things are going to be minuscule in terms of the 67 cents per business mile I'm going to get on that vehicle. I'm going to get over a $12,000 deduction on that car. So yeah, I'm going to take that. So plan accordingly. Make sure you take the right deduction in the first year so you don't miss out on things. And plan going forward too. So if you buy an inexpensive vehicle, you're like, well, in this first year I can get more deduction via bonus depreciation, section 179, whatever it might be. But going forward, I'm not going to have much maintenance, repairs. There's not going to be much depreciation left over. But I am going to be driving it a lot for business, right? I'm going to have a lot of miles on it. If in the future the mileage kind of makes itself better than the actual expenses, look towards that as well. Take a little bit of hit in the first year, taking the mileage deduction because you know it will benefit you going forward. So always plan for things, always talk about things with your accountant. It's best to be planned for all the activity that you're doing. But as we can see, the home office and the vehicle are two things that when you put them together can make an extremely good tax advantage for you for things you're already doing, right? I have to drive to work. I have to drive to meet my clients. If I can establish that home office, I have just massively increased the amount of deduction I get for that vehicle that I already have to pay for. I have to pay for the gas. I have to pay for its maintenance and repairs. I have to do all these things. I have to drive it to be those clients. So if I can establish that home office, whew, I just massively bumped up my deductions. Again, if I have that home office, I already have to pay to live somewhere. These are sunk costs that are available to me that I might be able to take my business. Plan your activities accordingly, and you can be able to take those things. All right. Now, like Mike had mentioned, another question, another thing that people talk about all the time is that S corp, that single member LLC. What should I be, an LLC or an S corp? Well, there really is no differentiation between LLC or S corp because an LLC can actually elect to be treated as an S corp. But semantics aside, an S corp is a great entity because it can help you save on Social Security and Medicare tax at a higher level of income to help you take advantage of QPI, a little bit lower audit risk. And if you're in a state that has income tax, that has the pass-through entity tax election, you can also be able to take a little bit more of a deduction for paying state income tax for the shareholders. But do know there are other things that go along with being an S corp, right? You have additional filing requirements. There's additional return to file at the end of each year. There's payroll and bookkeeping costs you're definitely going to need to have to make sure that your payroll is in good order by making sure you're tracking your income well. You have to pay for someone to run payroll for you. You need to make sure you're staying in compliance with having a reasonable salary. So you're going to need to check that. You have a little bit more compliance issues with the S corporation, and it's not something that you can just come in and out of, right? If I am going to be electing S corp status, and I elect that, I have until March 15th to elect that for this year in my LLC. I elect it. I'm now an S corporation. And let's say next year I'm like, I don't really want to be an S corp next year, so I terminate it. I can do that, but I cannot re-elect that S corp status for another 5 years after I terminate. So do understand there are some advantages and disadvantages, but the main advantage is this, right? So this is the main thing people are looking at, right? It's that saving on Social Security and Medicare tax. What do I mean by that? Social Security and Medicare tax, FICA taxes, or self-employment tax, right? So if I'm a sole proprietor, right, I have a self-employment tax on the net income, the profit of my business earnings. If I am a W-2 employee, I have FICA taxes. I have Social Security and Medicare tax, right? Those are the same thing. It's a 15.3% tax on that earned income, right? So with an S corporation, I only pay that 15.3% tax on the wages I pay myself, on the W-2 that I pay myself as the officer of that company. Whereas on a single member LLC or a sole proprietorship, I'm going to pay that 15.3% on the net profit of my company, right? Because there is no W-2. I don't pay myself a W-2, right? I just pay myself distributions out of the company. It's 92.35% of that income, but essentially your earnings in your company, your entire earnings in your company are going to be subject to self-employment tax. Whereas on the S corporation, only the W-2 I pay myself. So I have the ability to control the amount of Social Security and Medicare taxes I pay every year, which is a tax I can save on. That's the main advantage for an S corporation. The other thing too is once you reach a certain level of income, you begin to phase, well, I should say this. You change your calculation and then you begin to phase out of being able to take the QBI deduction. The QBI deduction being a 20% of your business income deduction. So if I make $100,000, I get essentially a $20,000 deduction on my tax return to reduce my taxable income, right? Well, once I crest as a single person $192,000 or a married filing joint $384,000 of taxable income before QBI, it changes from its calculation of just being 20% of your business income to the lesser of 20% of your business income or 50% of your wages, right? Two of the most easy calculations. So if I have, let's say, a $200,000 of business income, well, that means I'm now in this new calculation as a single individual. I'm in this new calculation. And if I'm a sole proprietor or a single member LLC, I don't, I don't have any employees. It's just me. I have maybe some contracts, but I have no W-2 anything. And I'm definitely not paying myself a W-2. So what that means is my calculation is going to be 20% of my business income, which is $40,000, or 50% of my wages, which is zero. So the lesser of those two is zero. So I get nothing. Whereas if I was an S corporation, let's say on that $200,000, I ran myself a $100,000 wage, right? So that means I have $100,000 pass through income, right? And that means I get a $20,000 QBI deduction, $100,000 times 20%. Or what's lesser, that or 50% of my wages, which would be $50,000. So that means I get the $20,000 QBI deduction that I otherwise would have just completely lost out on the single member LLC. So there's also that to take into account. Now, I do understand as people in our fields, accounting and health and medical and things like that, we actually phase out eventually of being able to take QBI as well. So this can come in as an important factor and then go away. So it does have its advantages, disadvantages when it comes to QBI. It's a very complex topic and something that is worth discussing with your accountant when you're making this decision. But the main idea is if you're looking to save money on taxes, S corporations can, but not always. You need to weigh all of these things with each other. We usually recommend about $100,000 of net income. It starts making sense for most individuals to take the S corp election, because at that point, the tax savings will at least be equal to the additional costs of having to pay for payroll, bookkeeping, the additional filing fee for the 1120S, the S corp return. Those things can kind of weigh out against each other, and the change in QBI deduction. That's where I see it begin to make sense, right? The higher the income, the more delta I have between my self-employment tax uh, paid and the amount of FICA tax paid. I have a higher delta in that tax savings, which just results in more and more advantage in being the S corporation. But do understand, it is not carte blanche. It's not just I have a business. Oh, go be an S corp. You'll save money. Uh, maybe. Actually, maybe more of a headache than it's worth. I might be paying way more money than I need to be an S corporation, rather than just having operated as a single member LLC, rather than just having operated as a sole proprietor. So do make that with the knowledge of what it entails to be an S corporation. Make it knowing I got to run myself payroll. I got to figure out what a fair and reasonable salary is. I really need to be keeping track of my profit and loss of my business, or else I'm not going to be able to make these pivots, or I'm going to have to run this final ditch year end payroll for myself. I'm not going to have the taxes to pay it. And it's going to be more of a headache. I've seen more people that are like, I'm not saving any money being an S corporation. I can show them that they are, but they don't feel like they are because they're not keeping track of their business the way that they should. And it was a bad choice to be an S corporation. Or they aren't saving any money. They just elected it and they're making like $20,000-$30,000. I'm like, you got to run a wage for yourself at this low level of income. It's really not worth it. We got to pay for all these other things. Doesn't really make sense. So to make sure you talk about those things. S corporations can be great, but they can also be a little bit too soon. They can also be a lot more of a headache than it's worth, especially if this is like a side gig that you're doing. So make sure you're well aware of the implications of electing S corp status. Then to wrap up, just a few quick things here. Other deductions you can take for yourself, right? They're for yourself. They're for your retirement. They're for you in the future, like a solo 401k or a SEP IRA. These are two great things that you can also take advantage of, especially if you have no other employees in your business, right? So I'm not having to worry about matching what I'm doing for them. So just as a quick example, 401k on the same level of income, I can contribute more towards my retirement than I can with a SEP because I have something called an employee deferral, right? Which I'm sure you know about if you've had a W-2 job where your employer offers 401k and you say, take out this much money to pay towards my 401k. That's you, the employee, deferring that money towards your 401k. Then the employer's match is their contribution. The employer contribution is then a deduction from the company into your 401k. So it's just another deduction, right? So if you are both the employer and employee, right? So if you're the business owner, that means you get to do both, right? So if I have a Schedule C, a single member LLC, sole proprietorship, and I set up this solo 401k, well, I can defer. Let's say I make $100,000. I can defer the $23,000, the employee deferral. I get that. No problem. So I'm able to take the $23,000 deferral. I got that put away towards my 401k, reduces my taxable income by $23,000. I then also have the employer contribution. And in the case of a single member LLC, sole proprietor, it's technically about 20% of the net profit of the company. In other cases, it's a max of 25% of the wages paid to the individual for the employer contribution. So what that means is you could contribute a max of say $100,000 earnings on a Schedule C. You could do the $23,000 towards the employee deferral, and then you can do 20% of $100,000. You get $20,000 from the employer contribution. You get a $43,000 deduction against your taxable income by contributing that to your own 401k. Obviously, you don't have to contribute that amount. You can contribute less than 20%. You can contribute less than 23,000, but that's the maximum amount that you can do, which is pretty great. And if you're an S corporation, that same situation, let's say you had $100,000 W-2, right? Because that's what it's going to be based on. So say you paid yourself $100,000 W-2, that means you could do the $23,000 deferral. Plus, you could do 25% of that $100,000 W-2. You could do $25,000 of an employer contribution. So it gives you a $48,000 max. And if you're over the age of 50, there's a $7,500 catch up in employee deferral. So your employee deferral could actually go up to a $30,500, or for 2024, went up by about $500 more dollars. And the max allowed between both the employer contribution and the employee deferral is $69,000 for 2024, $70,000 for 2025. So you can't go over $70,000 total combined between these two for 2025, and $69,000 combined for 2024. It's pretty sweet. So, and the reason where a 401k is going to be a little better than a SEP IRA in terms of trying to get the most out that you can is that I can do more of a contribution with that employee deferral than I can with a SEP IRA, because the SEP IRA is only employer contribution. So same thing as a 401k, but only the employer can contribute. So again, it's about that 20% of your net income if you're Schedule C, or 25% of your wages. So like in the last example, sorry, your slides are missing the second thing there of 25,000 for the W-2, but the 20% of $100,000, I can put away $20,000 to my SEP, or I can do $25,000 on the 100K W-2 that I paid myself, right? So I can do that with a SEP. I don't have the employee deferral option, but the reason why you would go with the SEP over the 401k is because the 401k does have a little bit more administrative fees in order to keep it in compliance, whereas the SEP IRA basically has no filing fees, and so it's very easy for you to set it up yourself, contribute to yourself, manage yourself, things like that. So what you're looking at is ease of use for these two. The 401k, you definitely can do more. Now, again, at the end of the day, this should be something where you talk about with your financial advisor and your accountant, see what makes sense for you. These are maximums. This doesn't mean this is what you have to put away. You can always put away less. And if you're going to put away less, that's where you're going to make the determination between what's better for me, a SEP IRA or 401k. If I'm not going to be doing even the $23,000, then, a SEP might be the better option for me. But a financial advisor could definitely be someone that can help you set these things up. Then your accountant can help you make sure that you are, doing them correctly and paying into them when you should. Last thing I want to throw out here, important deadlines to remember. So in a few days here, all 1099s to contractors need to have been sent out to them and filed with the IRS. Partnership and S corporation returns are due on March 15th, but you can extend them to September 15th. So you got a little bit of time on those. You also, your ability to elect S Corp status for 2025 is March 15th. You have till March 15th to make that election as well. So do know that for 2025. Personal returns are due on April 15th. I'm pretty sure it's still April 15th, unless there's a holiday around that, which case it could be like the 16th or 17th. But you can extend that to October 15th. You get a 6-month extension, but you have to actually file for that extension. But do you know that does not extend your time to pay your taxes? When it comes to the personal tax return, your taxes are still due April 15th, even if you extend it. It's just an extension of your time to file without penalty. You won't have a late filing penalty, but you will still have a late payment penalty. So do make sure to get your payments in. Make an estimate with your return if you're not able to file by 4/15, or you'll have a 0.5% per month late payment penalty plus some interest that accrues on what is due on your taxes. And then your quarterly estimated taxes, if you pay those in April 15th, June 15th, September 15th, and January 15th of the following year. That's when those things are due as well. If you're looking for me online, you can find me on YouTube. I'm Nick the CPA there. And I post long form videos of my educational content and things like that on there. I'm less frequent. I'm less on there just because it requires a bit more of my time and energy. So I'm trying to get better at it, but a little bit less on there. I post more often on TikTok and Instagram, usually the same videos on both. But if you're on one of those platforms, be sure to follow me on there. I'm Nick the CPA on TikTok and Krop the CPA on Instagram because someone stole my name. And that's about it. Cornerstone Accounting. Nick Krop, that's where you can find me.
Awesome. Thank you, Nick, so much. That was awesome. All right, so we've got a couple questions, and I just want to encourage anyone that's watching this to check out Nick's content. I said LinkedIn earlier, but you're right. As you you kind of checked me that you aren't really that active on LinkedIn. It was TikTok. But the reason I ended up reaching out to Nick, and this is maybe a good encouragement for people to just be bold, is I'm so sick on TikTok. There's so many grifters, and there's so many people that are giving terrible advice and terrible content. And Nick's content is very educational, very snappy. As you can see, he talks at a nice high clip, which I appreciate. But it was not telling you how to get rich quick. It was a lot of it was dispelling stuff on TikTok that was wrong. So definitely give him a follow. I've learned a lot from your content, Nick. So I love
Appreciate
that
that.
you're doing that. I know it does take a lot of time. All right, so we've got some questions here that I want to get to.
Mhm.
All right, we'll start with Julie. So I have a home office and work from home 2 days a week. On my in-office days, I usually spend an hour catching up on admin work before traveling in. How do I document that I start my day in my home office? And I think this is probably in relation to the idea of
Mhm.
not a commute, but rather office to office business miles.
I mean, how you log the things, how you defend what you're doing is as simple as you could just write it down. You could have a daily journal. You could have it on your calendar, something like that. Something that is just proof of before I go into the office, I always do these things. You can just have a task list that you're doing. How often is the IRS going to be auditing that specifically? Not often, but in case they ever do, you just want to make sure that you're able to show to them what it is that you would be doing, right? So typically you could just say, hey, typically on the day before I leave, I have to answer all these emails. I need to send out all these invoices. I need to do all these things. And I do that on a regular basis before I leave home. This is where I do my administrative activities. So
Okay.
what is the black and white answer? There is none. It's do something to provide evidence for the things that you're doing. I wish there was an easy way to do it, but the IRS actually does not have a specific way. They say you must log your essentially material participation in that activity. Just do what makes sense on that one.
So I'm going to add a follow on to that. A lot of healthcare providers may have W-2 employment that's their primary job, but then have
Mhm.
1099 work that they're doing in addition to their job. So if you were starting your morning or maybe even after your day job, if there's a mix of 1099 and W-2, how do you handle that in terms of business miles or commuting? If I'm going from 1099 work in my home office to then my W-2 job, how is that applicable or no?
So in terms of your home office usage, I know the IRS really wants to make it so that it's like you're only doing your trader business in your home office. So the technical answer is try and do your W-2 work outside of it. But if it's de minimis to the amount of 1099 work you're typically doing at home, right? I do my W-2 work in the office over there because that's what they're paying me for. I might answer the occasional email over here. It's de minimis. It's not a huge part of what you're doing. You're mostly doing your 1099 work here. That's totally fine. I wouldn't worry about that general mix. But do understand, just because you start off working in your home office, even if you do establish that my 1099 work, even though it's side work, I have an exclusive use space. I'm using this. That's always where I do my 1099 work because I have no second office for my 1099 work, right? There's no other place I can go to do that work then I definitely have exclusive use space, regular use for my home office. But when I drive from my home to my W-2 job, those are not business miles because now I've shifted from being a 1099 contractor to being a W-2 employee. So those miles wouldn't be deductible between my home office and my W-2 job, only from my home office to my second business location that is for my 1099 work, if that makes sense.
Excellent. All right, here's another one for you. Can contribution be made for 401k at age 65 or older?
I believe so. At the end of the day, talk to a financial advisor to make sure about those compliance things. But yeah, you can contribute to retirement accounts even after you're able to take out of retirement accounts. There are a lot of clients I have that basically it's just kicking the can down the road. They're like, hey, you know what? I'm making a bunch of money this year. I'm not going to be next year. Well, I can defer this, and then I can I can just take it right out the next year. It's taxable, sure, when they take it out, but maybe they'll be in a lower tax bracket. So it is a bit of a planning technique when you are above 59 and a half to contribute to that 401k or IRA, whatever it might be. Now, that said, definitely double check with a financial advisor that can know all the rules around 401ks and SEP IRAs about that. I do believe so. I do believe you can, though.
Excellent. And Bernadine, we had Frank on yesterday, and we have his contact information. So certainly he might be a person to contact regarding that question. All right, Nick, one more question before we let you go. So Susan says, can you use a 401k that you currently have, or do you need to open a new one?
So if I have a 401k like from an employer, it's not really mine, it's actually that employer's. So if I'm going to have a 401k in my business needs to establish it. Same with the SEP IRA and things like that. Like your business needs to have one established in its name. So you can always transfer the funds that are inside of another one and put it into this, I believe. But in order to actually have your business partake in 401k or SEP IRA deductions and things like that, it must establish one in its name. So, yeah,
Awesome. And last question, Nick. I know I just said one more, but
that's fine.
as you were giving your talk, I went on to one of my PA Facebook groups and just searched accountant.
Mhm.
And I found 4 different mentions of people looking for accountants in the past week. Obviously, it's that time of year. So, to leave our audience, are you taking clients? Do you do clients that work in healthcare for tax preparation?
I do. I do work with clients. I will say we are still taking clients right now. If you guys want to reach out to me, absolutely. My general recommendation would be this, though. If you are someone who especially has a business, things like that, definitely have an accountant, whether that be me or anyone else. Have someone that you can go to ask questions to who understands your tax situation. It's very important. And try to establish it with someone who is going to be an accountant all year round, not an H&R Block, not a TurboTax advisor or something like that. Find someone that you're going to be able to talk to during the year as questions come up, right? Because taxes are more than just a February, March issue. They are a year-round thing for business owners. So do have someone. But yes, do you have my contact? If you're able to put my contact information out there, it wasn't that last slide, but it was pretty quick. Um, Feel free to send me an email. You can go to our website and submit an inquiry, and we can always set up a time to chat from there and see if we'd be a good fit for anyone that's looking for an accountant.
Perfect. Thank you, Nick, so much. This was awesome. We'll make sure that the contact information gets distributed to everybody. But I appreciate you taking time on a Saturday to spend it with us, and I hope you have a great day.
Yep. Thanks, guys. Hope everyone has a good one.